Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. Today, I want to talk about a tax strategy that even though 2025 has ended, we still can implement. You know that I always talk to you about planning before the year ends because there are only few strategies that can be implemented after year end if we still need to focus on reducing our tax bill for the year. So what am I talking about and who this strategy would be good for? This is what we're gonna focus on today. So let me share my screen. And as you know, I always like to start with a joke, and the joke today is kind of cute and sad about a mom who's explaining what taxes is for her kid. So she went and ate 46% of her cookie. All right, so what are we talking about? I'm talking about the cash balance plan. Cash balance plan is a very powerful tax strategy for high earning business owners. And who this going to be good for and what kind of strategy it is. It says a retirement strategy, and we're going to see how it works. So it's a hybrid retirement plan blending defined benefit and defined contribution features. Defined benefit meaning that at your retirement age, you will know exactly how much you'll be taking. Think about it like pension. Defined contribution, think about it like your 401k, 403b, where you contribute a set amount, you know how much you're contributing, and based on the account balance at the end of your retirement age, or when it comes to your retirement age, where you want to distribute the money, this is gonna be your benefit. So like depends on whether it's you start with the benefit or you start with the contribution, and that's the simple way of differentiating between the two. The cash balance plan is kind of a hybrid between the two of them, because the employer maintain hypothetical account balance for each participant, and the contributions are based and calculated based on actuarial formulas considering the age of the contributor, their income, the years till the time of retirement. And the contribution, same as with a traditional retirement plan, it grows tax deferred with annual crediting of the employer contribution and interest. Okay, so why is it a good deal? Why does it stand out? First of all, because it provides massive tax deduction, because the contributions are not capped at a smaller amounts as it is with the 401k or the traditional IRA or any of those retirement plans. Contribution can be up to 200 or maybe 400k or more annually. So that's a massive tax deduction. And you can do age-weighted contribution. The older owners benefit from the higher allowable contribution. So this is really good for the older owners who need to catch up on their retirement contribution and who have a lot of cash flow, and they want to defer their taxes. Tax deferred growth because again, all earnings compound without the annual tax drag. ERISA protection because it's shielded from bankruptcy and creditor claim. So it has a lot of good benefits. Okay, who benefit the most? Again, it's business owners earning 500k or even more with high consistent income. So if you're always a profitable with high profit, then this is definitely good for you. Even if you're a sole prop or you're a partner, but you're seeking catch-up retirement saving, you feel like you haven't contributed enough, you're worried about your retirement, and you want some tax saving alongside with it in the meantime, then this is something that will be good for you. Older business owners, so if you're 50 or above and you want to accelerate your savings, this is also for you. A professional service firm like law, medical, consulting, tax practice. If you're an S Corp or C Corp owner with a strong cash flow, then this would also be benefiting you. Okay, so the good news, as we said, that for the year 2025, you still can implement it. How? So if you implement the plan and you establish the plan by the tax due date by April 15, 2026, you have the plan formulated, you have the formulas, you have everything written in the plan by April 15, 2026, then you're good to go. And you can make your contribution by September 15, 2026 if you have applied for an extension. So in summary, the plan can be retroactively adopted for 2025 if you established it by the tax filing deadline. So that's the good news about it, that there is still time if you're still considering it for 2025 tax year. For 2026 and beyond, it's even better because we're starting a new year. So you have the whole year to plan for it. You don't have to do one lump sum payment. You have optimal time to establish the plan, and you allow a full year planning, not just toward like year end. The 2026 deadline, you have to establish it by December 31st, 2026 to reduce your 2026 taxable income. After year end, you still can establish it for prior year with extension relief, same as we said for 2025. So this is just to give you some timeline of where you stand and how to plan for 2026 and any future year unless the rules have changed. Okay. Maximize with multiple plans. 96% of cash balance plans are combined with 401k or profit sharing plans. Usually people don't just do it by itself because the reason they're doing it in the first place is to maximize their contribution. So most of the time they have a 401k or profit sharing plan along with it. It creates synergetic deductions significantly exceeding single plan limits. It allows separate design for owner versus employee benefit optimization. And I see that from a lot of my clients when we talk about retirement planning. Okay, but I have employees. Will I need to contribute the same percentage I'm contributing to myself? What if like if it's just one owner and a few employees? Usually that's a problem, or even if they have a lot of employees, like would have to contribute the same amount. And the good thing with cash balance plan that you don't have to. You can contribute up to 95% to yourself as an owner and only 5% to your employees. So it gives you a benefit here. So, and it definitely helps with attracting and retaining your talent, and like if you want to reward your long-term employees while maximizing your own that you yourself as an owner deduction. Okay, so the actual contribution limit, like again, maximum, like combining 401k and profit sharing, you can contribute maybe up to 70k or something. But with the cash balance alone, you can do 200 up to 400, depends on everyone's situation. And depends again on the age, the income, how much time do you still have to retirement, and your how much you're earning, and all of that. So when we combine more than one retirement plan together, you're looking about 300, 400, or maybe 500 in contribution, which means maybe 50, 60k in tax savings, which adds a lot over the years. Your that adds to like a lot into your wealth building. So definitely something to consider. Okay, we can like just to optimize the strategy, you can do some layered planning, as we said. Maybe with if you have like a good month in the beginning of the year, like if you're seasonal, or if you have good month in the beginning of the year, you can front load your cash balance plan, and then toward the year end, you can capture on your 401k and profit sharing. And as we said, you can allocate differently to owner versus employee for tax efficiency, and older owners can maximize catch-up contribution in both plans, whether cash balance or profit sharing and 401k. There is a design flexibility. So because you can customize the contribution formula to favor the owner or the long-term employee without being discriminatory. So you can do that. You can vary the benefit accrual rates within the compliance guidelines. You will still be compliant. You can integrate it with your buy-sell agreement if you're planning on selling the business, or you're thinking of business succession planning. We can do time plan establishment to align with income fluctuation. As we said, if you have like better month than others, we can do a plan like timing the contribution so that we optimize it the best way for our cash flow. Okay. Another advanced feature is some people, they integrate it with their life insurance so they can fund the life insurance premium within the plan using the pre-tax dollars. They can structure it to maximize both cash value accumulation and tax-free death benefit. You can integrate it with your wealth transfer, estate planning, and business protection. Also, it can create liquidity for buy-sell agreement at favorable tax treatment, as we said. So you can use it in an optimized way with a lot of other planning based on your situation, based on your goals as well. Uh, just some consideration when you implement this, it needs some stable income, like it's really required. So you need to have consistent contribution. So if you're a volatile business, you may be struggling if you go ahead with that. There is an actuarial cost, so you need to consider that because there is an annual professional administration and compliance required. And if you're a small business, maybe this is not a good fit for you. It is insured. Most plans covered by the Pension Benefit Guarantee Corporation. It requires employee communication. You need to clearly document and make and send disclosures to your participants, your employees. So a few things just to consider when you implement it. 2026, along with we're having the one big beautiful bill, the individual and corporate rate reductions create urgency for strategic planning. I cannot stress this enough. Retirement plan deductions offer exceptional tax efficiency through 2026 and beyond. You need to really consider consulting early in the year for maximum planning opportunities before year-end deadlines. Unfortunately, there were few that reached out like on December 30, December 31st, and they were seeking some help reducing their tax bill, and there wasn't much to be done because they were late. So better to plan early than later. Even sometimes December 15 is sometimes just late, so it depends. But again, the earlier the better. Don't wait till it's too late. Timing is very, very critical. You establish early to allow full year contribution planning instead of sending one lump sum, as we said. Is a cash balance plan right for you? This is more of like a checklist for yourself. If you're earning 250K plus, we said 500, but 250K at least consistently each year. Is your income stable and predictable? Are you already maxing out your 401K? Like if you're not even maxing out your 401K, if you're not thinking of your retirement, and if this is not really a goal that you have in mind, and you're just living day by day, then maybe you need to reconsider your goals and consider your financial plan. So if you're not maxing out your 401K, then I wouldn't recommend you a cash balance plan. But if you're already maxing out, you want to put more, then I would recommend it. Are you comfortable committing to annual contributions? And if yes to most of these, then this strategy may be a great fit. So the key takeaway, the cash balance plan offer high earning business owner a disciplined tax efficient pathway to substantial retirement savings while creating meaningful deductions. If you have any question, we really need to discuss your specific situation to see if this is a good fit for you or not really. So here are my contact information. Please reach out and let me know how can we help. All right. Thank you so much and talk to you next year. I'm sorry, next week. All right. See you.